One of the questions that arises most often in retirement planning is what option you should take with your pension benefit. This choice has major long-term consequences for taxes, portfolio growth, longevity risk, and the financial security of you and your spouse. It's a decision that can't be undone. And it's not just about the math, it's about your lifestyle, goals, and risk tolerance. Today, we're going to talk about pension benefit selection. All right, so Spencer, we serve a lot of clients that have pensions, whether they're government pensions or private companies that still offer pensions. And they come to us and have questions about, okay, I've got a joint pension option. I can take a lump sum. I can maybe even add some of my 401k dollars to grow my pension. What do I do? And oftentimes we have to look at this in concert with a whole financial plan and see, okay, what is going to be the best option? But what are some real key things to know on the outset about pension options?
Well, the first thing that we want to calculate is what's the real value in the pension payments over a course of a lifetime. So we want to compare that to a lump sum option. And this is important for a number of different reasons. And it requires some mathematical calculations, some actuarial assumptions that are out there. Now, typically a 401k provider or a pension provider will look at this and they will come up with their own calculations and they'll make an offer. And you're not going to be able to negotiate with them to get a better offer, at least not any that we've seen. So it's a take it or leave it. You either take the lump sum or you take the lifetime benefits. But we need to come back and say, okay, what is the real value here? Because in most cases, if you take the lump sum option, you could turn around and you could work with an insurance company and you could get lifetime payouts for them. So oftentimes, what's offered is a little bit higher than what's seen in the marketplace. So if you have a 401k provider or a company that has a pension or government has a pension, they are offering at a little bit higher rate than really what you could take that lump sum that they're offering also into the marketplace and get as a lifetime income stream.
Right. And sometimes we'll have clients that say, I love the employer that I worked for. Maybe they don't have as rosy of a picture of where they could be long-term. And so really you have to think about this in terms of risk as well. It's if you were to go try to purchase a lifetime annuity, do you trust that company and their contractual promise to pay over and above your company that you work for? There's so many levers that we have to think about when we think about these pension calculations.
One of the things we do recognize and clients will ask about is this pension benefit guarantee corporation that's set up by the federal government, administered by them. And what we have to come back to is that's helpful, but don't look at that as quite the same as FDIC insurance because it's funded with a separate pot of money, the contractual arrangement. It could be a situation where the federal government legislators would step in and provide stopgap funding, but it might not because this is a smaller subset of people. Let's just say we had a big American company, when it went under, let's just say, we've got a pension that was still there in place for Ford and they went under. Then the government could step in and say, okay, if the Pension Benefit Guarantee Corp won't pay here or doesn't have the funds to pay, we could step in and pay. But there may be enough of an outcry from other people to say, no, that's a private company. They mismanaged their funds. Their employees, yes, it's sad, but we shouldn't have to pay, for that mismanagement. So it's not a guarantee in the same way that we would have like the backstop of an FDIC type insurance. So it is really important to recognize that not all companies, not all insurers are the same in terms of their financial strength.
Right. Okay, so we've talked about kind of that lump sum, some of those risks that are involved in taking that, either that lump sum or the annual benefit from your pension provider. So the second piece we have to start considering is the health of you and your spouse. Why is this important?
Well, this is actually baked in with the actuarial assumptions that we just talked about. You've got to figure out how long you're going to live. And so as we look at what the company is coming to offer you, they're going to assume that you have a certain life expectancy. And if there is a spousal option there as well, they're going to assume your spouse has a certain, lifetime expectancy. If you have a much younger spouse, oftentimes you will see that if you take the survivor benefit, that survivor benefit will be far less than you might have expected if your spouse is 10 or 12 years younger than you. Some companies don't have that same offset. So you've really got to be careful in terms of looking out and saying, okay, how long am I likely to live, my spouse likely to live, and what does it look like in terms of the income streams that are going to be available, to us for that projected lifetime? If you look at it and you say, okay, let's just say you're 65 and you're in excellent health, and the break-even point is you need to live to age 81, why that's the odds are in your favor. Right. You are probably going to live that long, and so you would want to take that lifetime benefit rather than taking the lump sum most of the time. Now, if the break-even point is more like 88, then you might like to just take the lump sum because you say, okay, well, my life expectancy is to 86, and even in excellent health, that's not a risk that I'm willing to take. I'd rather go a different direction.
Right. Okay, so we talked about your health. Let's talk about this joint and survivor benefit that oftentimes is an option. So then, you're not only trying to take into consideration your health, but also your spouse's health. Because if you can pass along some of the benefit to them, that's a benefit to continue to allow them to have income over time. Talk us through that consideration.
Well, it's a key one, and sometimes there is a preferred option. For instance, I know at Oak Ridge National Lab, an employer just around the corner from us, they will oftentimes have the best actuarial benefit will be actually the 50% survivor benefit. And, they can do this for various reasons, but it tends to be the best deal that's out there. Now, that's not always the option that's chosen by a particular client, but oftentimes that is the best one in terms of the pension election options. So the fun thing here, though, is that you have insider information that the company does not have here. And so if you have good genes and your people tend to live a long time, let's say your spouse's people tend to live a long time, why that should help you lean towards taking that lifetime option that's out there, because that's going to be an income stream that's coming in for the rest of your life. And if you live into your 90s, statistically speaking, if you and your spouse are 65 and you retire, there's about a 50-50 shot that one of you lives into your 90s. But if you're in excellent health, then those odds go way up. And even to the point that it might be a 50-50 shot that one of you lives into your late 90s. So you're stacking the odds in your favor there. And the insurance company, as they put forth that offer, they can't know. They're offering this to thousands of different people typically. So they can't know your specifics. They just know the general population. So if you look around and you say, okay, I'm healthier than the average bear, I have maybe better education, better access to medical care, these kinds of different things, then tending towards taking the pension may be the direction that you want to go. If, on the other side of things, you know that you've had major medical events, and maybe you and your spouse both have had major medical events, and that your life expectancy is far shorter, then there's no reason that you should be taking that long-term pension. You should probably take the lump sum option, and then you can use it as you might need to, but with a shortened life expectancy, at least if you pass away over the next few years, you are going to be able to pass more resources on to your heirs.
Right. Okay. So this is kind of a broad generalization that we've talked about many times, but we always need to fit this into your financial plan. If you have other guaranteed income sources, how does that affect choosing a pension plan?
Well, the nice thing is, if you've got strong Social Security, say in a strong pension or some kind of annuity income that's guaranteed for life, oftentimes what you can do is then use other resources to be more growth oriented. So you want to look at this within the context of an overall plan. But there are a number of studies that are out there that would suggest that it's suboptimal to have resources that are, to have a substantial amount, I should say, in resources that are in fixed income early in retirement that are not earmarked towards being used in the very near future. So, if you're going by the old, 60% stock, 40% bond portfolio, and you want to keep it that way, indefinitely for the next 30 years, let's just say, there are a lot of studies that are out there now that would suggest that it might actually be better if you take some of those resources and have a lifetime income stream, whether that be via a pension or some kind of a guaranteed annuity, that would be out there, that would give you that guaranteed income stream, and then might allow more resources to be more growth oriented there for the future, because the rates of return on government bonds, let's just say over the next 30 years, if you're keeping it static there, probably not going to be nearly as robust.
Right. So how then does inflation factor into this key piece of deciding what do I do with my pension?
Well, if you are so blessed that you have the option of having a rising income stream versus a static income stream, then you're one of the few.
Yeah.
Be proud of that. When we look out over a 25, a 30-year time frame, and really the pension is most powerful as we see it go multiple decades into the future. You're protecting that income stream. So even better if you can protect it with a cost of living adjustment there. So 9 times out of 10, if there is that option, we would encourage clients to really explore that. Look at the numbers, do so with prudence, but oftentimes leaning towards that cost of living adjustment feature there that's going to protect against inflation. Right. Now, sometimes, and this is where you do have to read the fine print, sometimes there is a ceiling on that where it's only going to be 2% or 3% up to that amount. If the consumer price index is higher, it may not go higher than 2 or 3%, but it's going to be something there. And typically over a 25 or 30-year time frame, that something can add up very, very substantially.
Absolutely. Okay, so we touched on this a little bit at the beginning, but we need to talk about risk tolerance as well. Why does risk tolerance affect the pension selection?
Well, it does, because especially if you're thinking about your pension and you have a lump sum versus a lifetime income stream. Typically speaking, if you're going to take that lump sum and you're going to put it under your mattress and you're going to keep it in cash or in CDs, you would be better off just taking the lifetime income stream, again, provided that you have, average or better longevity. If you are very risk averse and you also have had medical challenges or what have you, and let's just say you have a shortened life expectancy, then maybe you take the lump sum and maybe you invest it conservatively. But for those folks that have, a significant, chance that they'll have 2-3 decades, maybe even more in retirement, if they're risk averse, having that pension and taking it as a lifetime income stream can make a whole lot more sense.
Right. So Spencer, one of the scary questions that people always think about when they think about taking that lump sum is this going to be a monster tax bill this year? How do we address tax implications?
Well, it gives you more of a chance to manage your tax bill. If you don't know what you're doing and you take all of the funds out that first year, then you can pay through the nose in tax. Hopefully you don't do that. Hopefully instead you look at this and you take resources out in a thoughtful way over a period of time. So typically, if let's just say you had an opportunity, and to make math really easy here, let's say you could take $1 million lump sum, or you could take $5,000 a month for life. So you've got $60,000 a year for your lifetime. Let's say you're 65 and you've got that $1 million over here on the other side. If you take the $1 million as the lump sum and you roll it over to an IRA, then you shouldn't be paying any tax on that if you do things properly. If you take the lifetime income stream, then every year, if you have $60,000 of income, then you'll have $60,000 of income to report to the IRS, along with other ordinary income and so on and so forth. The nice thing about the lump sum in this case is you can kind of choose when you pay tax, because you'll pay tax when you pull those resources out. So let's just say that you were going to have a fairly low tax year in the first year of retirement. Say you retired at the end of December this next year. You didn't have Social Security income, and so you took out $100,000. Why, that might be nice because you needed more income and you had lower taxes that year. So it can allow you to modify how much you pull out when you recognize that tax. Now, the other thing that it can do as an ancillary point is that with charitable giving, it gives you one more set of options. So let's say, again, you take that $1 million, you move it over to an IRA. You attain that magical age of 70 and a half when qualified charitable distributions can open up the options. Well, now, as of 2025, you can give up to $108,000 via qualified charitable distributions. Mm-hmm. So let's just say, you were really influenced by a group that was raising some funds and you wanted to make a $100,000 gift to them. Well, if you take that from your bank account, mm-hmm. you write a check to them for $100,000, you'll have already paid tax on that $100,000. Now, depending on other income that you have, you might be able to itemize that gift. You might be able to get some tax benefit. But again, you may not be able to get a ton of tax benefit on that, depending on how much your income was and the standard deduction that you have to get above and beyond. If you do this via a qualified charitable distribution, that $100,000 never comes to you. It goes direct to the charitable institution, so you don't recognize that as income, which can save substantially in taxes there. So that is one of the other small pieces, but we never want to put the cart before the horse here. Yeah. The tax consideration tends to be on the periphery of the decision because we want to make sure that you've got solid income over the course of your life and that you make the right decision. Here, taxes can be kind of one of those things that helps a little bit one way or another.
Right. All right. So the last couple pieces, how does this impact an estate and your heirs as we think about how do we make the selection for our pension? We've touched on it a little bit, but what other nuances do we need to know here?
Well, it can give you a level of security such that you may feel a capacity to pass on resources earlier, even than your death. Mm-hmm. So let's just say you have really strong pension and Social Security and you've got significant assets otherwise, you might feel much more confident that you can pass on resources to heirs in their lifetime, or that you can make big charitable gifts in your lifetime because you've kind of set things up where you've got enough income for the rest of your life. So that can be one key thing. Another thing is, if we think about some of the blended family type of situations, let's just say that you get married and you're in your late 50s or your early 60s, and now you've got this pension election decision. Let's say that you and your spouse have children from a first marriage, each of you, and you're concerned that you would like some of these funds to get passed on to your biological children. Maybe your spouse does not need those funds, does not need a lifetime income stream. Let's say he or she has plenty. Then you may want to take that lump sum and you may want to set as beneficiaries your children, in that circumstance. So there are some situations with estate planning where it can make sense, instead of taking the lifetime income stream and naming, say, a spouse as the beneficiary there if you should pass away, going ahead and taking a lump sum if you have different ideas of where you want those funds to go.
Spencer, thanks for walking us through the pension selection process. The reality here is it's really complex. There's lots of things that we need to consider. And sadly, usually it's a one and done decision. You make the choice and then you have to stick with it. Clients, if you have questions about your pension options, we would love to talk with you about it. As always, leave comments down below and we will see you again next time. Take care. If you like these financial planning videos, please share with a friend. And if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.